Welcome to our new Friday Focus series, which is picking up from our previous long-running FANG Friday webcast. SVA, or Structural Valuation Analysis, is a balance sheet-based approach to the market which merges fundamental analysis with what is known as technical analysis. And the lines that you will see on our charts are price to book breakpoints, and they apply to all individual stocks in all countries that we have examined using all accounting systems, as well as stock indices themselves. For those of you who would like to learn more, please go to strategicanalysis.ca. The technical aspects of SVA apply equally to the stock indices themselves, and that's going to be the central theme of today's Friday Focus webcast. So, let's start. Where are the Standard & Poor's 500 and the NASDAQ, that is the two principal U.S. stock indices, in SVA terms? Well, as it turns out, the Standard & Poor's is bumping right up against what we call its low super growth price, that's LSG price, which is 4.5 times book value. And the NASDAQ has been as high as its HB1 price, that's 9.5 times book value, although it's had a fair setback from there. Well, have these indices ever been there before? And the answer is yes, they have. But you have to go all the way back to 2000 to see when that was. And I think that what we see in 2000 to 2002 may be about to replay today. So let's go back there, and the first thing that we notice when we look at that chart is that it was pretty much for an entire year that the Standard & Poor's, because that's what this chart is, was banging up against its LSG price. Now, the reason that the market got that high, of course, was because we had had a very, very strong year economically, thanks very much to Bill Clinton's hard work at getting the U.S. balance sheet under control. Well, that all came to an end in the election of 2000 when George Bush came into power and began to undo some of the work that Bill Clinton had done. And as that happened, the market began to roll over, and it had a fair setback all the way from 4.5 times book value down to, as you can see on this chart, the G price, which is the growth price, or 2 times book value. And I very much suspect that that's going to happen again. Now, I've got to tell you something about that bottom. But before I do, I want you to notice that on the way down there were some very, very nice tradable rallies as the market came down and hit various structural breakpoints. And I think the same thing is likely to happen again. Anyway, on July 26, 2002, the market came down and hit its growth price. And I happened, by a happy coincidence, to be on ROB TV Market Call. It's now called BNN, Bloomberg Market Call. As I was in the studio, actually in the makeup room, waiting to go on, the moderator, Jim O'Connell, came in to talk to me, and he said, Ross, I presume that you're going to be bearish again. If you look at that chart, that last decline was almost a waterfall decline of prices, and I had been bearish then. And I said, no, Jim, the market bottomed this morning. And how did I know? Well, my data associate, Wan Ying Kwan, had been hard at work entering the last of the balance sheets into our Standard & Poor's model. And that was when I left the office. She called me and she said, Ross, I've entered the last of the balance sheets, and you know what? The market has hit precisely its growth price. So the value of SVA is very much in evidence here. I suspect that something like this may happen again. Well, why couldn't the market break out here? Why does it have to go down? Well, in order for it to break out here, first of all, the market is extremely expensive by all counts. And to go higher, we are going to have two things. First of all, we're going to have strong economic growth. And secondly, we're going to have an increase in margins. Given the Trump tariff war that is going on, I don't think that we're going to have strong economic growth. And if we don't have strong economic growth, then we are not going to get an increase in margins, in which case the market, I think, is up against its peak. And we can look forward to a setback, to something that approaches good value. One thing we know about the markets, when they get going on the downside, they can go further than we expect. Something as happened back in 2000 and 2002 may well be about to happen again. I suspect that there are going to be some interesting times ahead of us, some interesting risks and some interesting opportunities. That's it for this week. I will see you next week.